What's up, everyone? Welcome to Money Market Truth. I am Marcus, and this is...
Hi, guys. This is Mo from OTB Clubhouse.
I know it's been a rough week for a lot of people, so we have some good information here on the agenda. And as usual, at the end, we're going to cover a few lessons here. I'm going to cover a stock. He's going to cover another lesson that he's going to basically get into. So today, Mo, what's on the agenda?
So we want to talk about something very key, which is FOMC, which is happening tomorrow. And then we also want to talk about how do you navigate this market here? Are we in recession? Are we bear market? Is this the bottom? And we want to give you actionable steps rather than talking like a macro trader, because macro doesn't really get you anywhere. You need to know it, but you need to know the actionable steps. And that's what we'll go over today.
Yeah, absolutely. The first thing I want to touch on, though, real quick, is buying the dip versus buying the downtrend. I think a lot of people were a little bit confused in the beginning, especially when there was a lot of these YouTubers out there and on Twitter and financial gurus and stuff. They always tell you, buy the dip, buy the dip, buy the dip, dollar cost averaging. But we've been in a downtrend, and I want to talk about that a little bit. There is definitely a difference there. Buying the dip is when you have bought a stock when it's at the close to the near bottom, and then it goes back up. Buying a downtrend is basically what a lot of us have been doing for the past couple of months. I'm in the same boat. I've been buying Square since the downtrend, and that's not the same. So I want people to try to understand and start learning the difference between buying a dip and buying a downtrend, because every single time when there's like a 5% drop or if there's like a 6% drop, people are saying buy the dip. And then you're in a situation where you bought Square at $200 and now it's, I think, at $60 right now. So it doesn't make you stupid. It doesn't make you naive. You just didn't know. You thought you were buying a dip because, again, who would have seen the market go down as far as it did right now? I know there's a lot of people out there who make a living selling programs and telling you, I knew this was going to happen, I called it, blah, blah. But the reality is a lot of us don't even know when the bottom is. And if we're going to stay, how long we're going to stay in a recession, how long we're not going to stay in a recession, when things are going to bounce back. It's just all theories. So the thing I want to say is right now for me, what I'm doing is I'm staying cash heavy. I'm no longer buying the downtrend because, again, technically I wasn't buying a dip. I was buying a downtrend. I'm literally just putting cash to the side. And then when I see a clear reversal, again, what does a clear reversal mean for me? Well, for one, I need to see us come out of a recession. I need to see inflation go down. I need to see the interest rate get cut back somewhat. I need to see that the CPI numbers are changing. I need to see a lot of stuff. I need to see us pull away from the whole Ukraine-Russia war. I need to make sure that we don't get involved in the whole China and Taiwan situation. I need to see us pick up on fertilizer, because we're shortage on fertilizer now. We're short on a lot of stuff, supply chain issues. Like I said, there's a lot of stuff that we're dealing with right now. Elections coming up as well. So I think that could possibly also affect the market. So there's a lot of stuff that I'm waiting for. So once I feel comfortable, again, that's my risk tolerance, then I will start buying in. That being said, your risk tolerance may be different. You may have a bunch of levels that you plotted out for the past year or so, and you're just buying if those levels hit. Doesn't make you stupid. It does not make you less smart than other people. That's just what you're doing. That's your strategy. That's your plan for your portfolio, and continue to move with it. What's your thoughts?
So we want to give you context while we're talking about it. A lot of people on social are shitting on each other for buying stuff on the high. The thing that we want to talk about, and me and Mark were going over it, let's say I'm in real estate, right? And I'm an investor. So let's say I own 5 properties. My goal is to keep buying more. That's my goal, right? Mm-hmm. If the market goes down, I'm buying more. I'm not selling what I have. Similarly, in a bear market, you shouldn't be selling your stocks. You're supposed to buy. That's an investing way of doing things. Then you've got traders. I'm part of it. So what you do is you buy at a level. If it fails, you have your stop, and then you get out. If it goes up, you take profit. That's how you do it. In the long run, though, investors usually win. And it doesn't matter if you're in real estate or stocks. So what I want to say is, let's take an example. You bought Ethereum at, let's say, $3,500. It went to 5K and you didn't take profit. Now it's at $1,500. You're buying more. You believe in the product. You believe in the stock. And your sole focus is to own as many as you can. There's nothing wrong with your strategy. If you go on Twitter, though, you are stupid and you have no idea what you're doing. I don't agree with it. I just think it's a different path. You have your blinders on. You're going on a certain way. I think as long as it works for you in the long run, it's okay. It's just different ways of making money. Not one is right, not one is wrong. Now, to answer the dip and downtrend, I will tell you this, and no matter who it is, no matter what algos they own, no one can give you a precise number, including us, and say buy Apple at this price. It doesn't mean that's the bottom or that's the dip. What we're looking at is where do buyers show up historically. Then we're looking at if Apple is at this, where can SPX go, or reverse engineer? If SPX goes here, where can Apple go? So historically, bottoms, again, this is historically, history always doesn't repeat itself. It always rhymes though. So historically, weekly, on a weekly chart, 200 moving average is where we bottom out, which is 3,500 right now. And you could see, okay, so if SPX goes to 3,500, where could Apple possibly land? And you can look at a number. The answer for the bottom is Fed. When the Feds change their tune and their sentiment and they intervene, that's when the bottom will kick in. Usually what you'll see is first you get the Fed reaction, and then you get an overreaction by the market, meaning we sell off more, and then somewhere you find buyers. Usually a true sign of bottom is where there are no buyers. And a lot of people think catching bottoms easy. It's one of the hardest things to do, so you don't do that. I just wanted to make it clear because be it me, be it Mark, be it anyone that's charging you 100K for an algo or whatever, there's no way to knowing the dip. Goldman Sachs doesn't know where the dip is at. They keep changing their statement every single week. They started from no recession to 1 in 3 chances to now 50-50 chance of recession. So no one has any clue where the bottom is. We're just watching levels like everyone else. And that will basically let you assume where the next moves are, and then you anticipate based on that. And that's what us traders do.
Yeah, and I don't want to like make it seem like we're backtracking what we've been saying in past previous episodes and so on. Even on my own channel, I sometimes shit on people buying the dip or the downtrend. And I want to be very clear when I'm shitting on certain people or certain gurus that are saying, buy a dip. I'm talking about the stocks that are like not good.
And they're never going to come back.
Yeah, the ones that are not coming back, okay? If you are buying Apple if you bought Apple 160, you bought Apple 150, 140, 130, 120.
Even 180, man.
You'll be fine. You'll be fine. Right? So there's no issue with that. I'm just talking about the shit stocks. I did a whole episode on with the shit stocks. Those are the ones that I would say, like, be careful with so-called buying the dip. Also, again, they always say, right, in a bear market is what makes people rich, right? And it's all about how long you can hold a stock. If you don't have money right now, again, because we are in a recession, inflation is going to go higher, prices are going to go higher. If you do not have money, and if you're worried about whether or not you're going to have a job in the next couple of months, whether or not you're going to have enough money in savings, Again, I'm not a financial advisor. I wouldn't buy anything. I would literally put my money to the side in case of an emergency. And then again, if things start looking different, then I will start deploying money. And again, I wouldn't do one huge lump sum of money right here. I would start buying and scaling in as it goes up. What I hate though is just that these gurus and these people on Twitter are just making it seem like Mo was saying, you're stupid for buying the dip, or you're stupid for not buying the dip. Because again, it's all up to what your risk tolerance is. Everyone's risk tolerance is completely different. Like I said, I was buying all the way up until maybe 2 months ago. Then I stopped buying because I'm just done seeing my portfolio tank as I'm buying stocks. And I also know that there's some gurus out there now who have been giving you guys price targets for the past 2 years. Those price targets have blown below. So if you bought stocks within the last 2 years, they are down. And now they're going back in their feed and they're deleting their calls and making it seem like the only ones that are still up, those are the ones that they called, and that they're the ones who call the recession. Be careful, y'all. Don't allow that stuff to mess with your plan that you set for yourself. Have a game plan, stick to it. Who cares what anybody else says? Who cares what we say? If I say, hey, I think it's stupid that you're buying GameStop right now. Hey, if GameStop is in your strategy, go for it. Just go for it. But just know that things are just not looking good right now. Things can go lower. I have this conversation with a guy at my job all the time. Like, he's always like, it can't go lower. There's no way it's going to go lower. He said that literally like 3 weeks ago. There's no way. Historically. Yes, I got you. Historically, like Mo said, it's historically, yes, sometimes that stuff works, but it's not always accurate, because also historically we've been in a situation that we're in right now. That's another thing. We are in a situation that we've not been in before. So we have to think about that when you're looking at the data and when you're looking at technicals. Technicals is important, but again, that's only one part of the whole game plan. There's macro, micro, there's fundamentals, which play a huge part. And right now, things are just, again, not looking good. Companies are laying off. We talked about that last episode. Stocks to guidances are not looking very well anymore. People are losing money. There's supply chain issues. I mean, there's so many issues out there. So just be careful. If you're going to start entering into positions, just be okay with knowing that it may take you 5 to 10 years to recover. The reason why I'm not buying the downtrend again is because I prefer to wait and try to catch the bottom as much as possible. I'm not going to catch the bottom. I am fully aware of that. But if I buy right now, let's say again, had I just waited for Square, for example, and just waited for it to go to 100 and then bought, it's at $60. Well, I would have been more comfortable knowing that when it bounces back, I'm going to recover a lot quicker than where I bought at initially, which was at $200. So it's just seeing like where you feel comfortable at and how much you want your portfolio to go down and how long you're willing to wait for you to recover and go green. So that's all I got on that.
Awesome. All right. So let's talk about FOMC. So we have Pavel speaking tomorrow, and then we have Pavel speaking on Friday. We've had 3 days back to back where SPY gave you a negative 2% return daily. We haven't seen that kind of negative return since COVID lows. Now, if you notice the action in the last 30 minutes, what you take from it is the buyers came in and they didn't let us go below 37.35. That was the SPX area I was watching. So 37.35 on SPX is what I was watching. We closed above that, and that's what I was looking at. I got into 385 calls for SPY on for Friday, got them at 140, alerted on the Discord and on Twitter, and they went to 190. So you were up about 43% within about 9-10 minutes. Sold half, so now I'm swinging the rest. In the last 4 FOMC, what we've seen here is we get a bounce. And the reason why the bounce happened is more important than just thinking about the bounce. So what's happening here is, let's say you got into puts and now SPY is down 7% since you've got puts. Depending on how much you paid, how long your puts were. I know a guy who got an SPX put for $2. It's worth $50 now. So it went from 200 to 5K. Would you want to hold that before Pavel speaks? Absolutely not, right? So what you do is, people that are buying short-term puts, they're going to start taking profits. When you start taking profits, it's called short cover. When that happens, the market maker has to buy back the stocks and basically causes a rally. When that rally happens, that causes a chain reaction. So I sold, Mark didn't. But then Mark sees SPY going up. So Mark's like, fuck, let me sell it too. And that's what causes the rally. In the last 3 FOMC, that's what we've seen. We've seen the stocks rip after. So I'm thinking we can see 3,800, then 3,850, and then 3,900. The recovery usually lasts 1 to 2 days. So we've got Wednesday and Thursday where we should see the recovery. And then from there, we should see us go back in that same bear cycle. Now, let's talk about hedges. There's some hedges. So about 150 million worth of hedges are on the fresh ones. They're on for this week. Not all of them are going to come out. So there will still be hedges, which actually protects us from going lower. And the reason for that is because everyone's so well hedged, everyone's in agreement. There's a balance in the market. The imbalance will happen when people will cover their short. So when people are selling, all of a sudden they're imbalanced, which is going to cause their rep. So there still will be puts. What I'm trying to say is the institutions, the MM, aren't just going to be like, let's get off hedge because they need to stay hedged. Okay? That's not what I'm talking about. I'm talking about the short-term puts. They are going to come off because they're in the money. So that's why we get the rep. So that's what you need to watch out. For traders, if you are new, personally, I would say stay out because you're going to see so much volatility. You could see a 30 to 50 point move in SPX in a minute, in 2 minutes, and you're not going to know what's going to happen. It's going to leave a lot of pain because you will be in profit, then you'll be in loss. So paper trade it if you don't know what you're doing and learn the process. So that's kind of where I'm coming from FOMC. In terms of macro standpoint of view, we had an understanding that Fed's looking at doing 50 base point increases, right?
Mm-hmm.
Last week it came that we might go 75 based on the bond market and different analyst opinion. The 75 base point is already factored in with the sell-off that's been happening,
Correct.
which means that if we do get 75 basis point, it's expected. So you get your hedges off. If it goes 50, oh, it's better than expected. So we rep. So that's where I'm going with. I only have SPY calls and I'm going to trade. The best calls ever to, so if the market's dead and you think market is going to reverse, the way you pick the stocks is see where we have relative strength and where the flow is coming. So the flow is coming into three things: Apple, Microsoft, and Baba. So maybe keep an eye on that, but that's how I would go over the place tomorrow.
Yeah, Baba. I would say still be careful with that because of some of the news with China.
Oh, it'd be a trade. Like again, if you, so what did we do today? SPY went from 140 to 190. What's the first thing? Sell half, sell 80%. The moment you swing anything in this market, anything, it's a lotto now because you don't know what's going to happen overnight. We're not in the same market we used to be. So absolutely, like, day trade it and then only swing whatever you can make it free. That's risk management.
Got you. And just to speak on the whole FOMC, it seems to be a trend these last couple of times. It sells off like the week prior because they're expecting like whatever the point is, 0.50 or whatever he's planning on raising it at. It seems like they kind of bring the market down, and then the day of they rip, like you were saying. But it's not guaranteed, right? I mean, it could just do the complete opposite tomorrow.
Nothing is guaranteed. If a tweet comes in from one of the Fed members and they say, "Well, we're going to do 1% or we're going to go harder on quantitative tightening," everything is speculation.
Yeah, yeah. And the quantitative tightening is going to continue to happen. I think I was reading in August, that's when the big one's coming, 9.3 billion, something around there. No, or 90 billion, I think it was.
Well,
It was some ridiculously big number. And I know a lot of people were comparing it to 2017. There's two factors I want to talk on. The first one is that in 2017, our economy was completely different when they were trying to tightening. So we were a lot healthier. We weren't, again, not involved, or technically we're not really in a war yet, but we are supporting a war. We weren't dealing with any of that stuff yet. Well, a newly established war, should I say. And it didn't go very well in 2018, 2019, hence the reason why they stopped the tightening. This one is going to be different. Not only are they planning on taking more money off the books, our economy is very very fickle right now. So that's a thing to keep in mind as well, because I think it's August. I should just double check though, but just do your due diligence. I'm pretty sure it was $90-some billion that's going to come off the books.
So yeah, June is also the worst month as well. So that's why I don't think if the rally happens, it's going to last long, because you've got end of month flows, you've got rebalancing, you've got a lot of factors that are going to force the sell. But yeah, like Mark said, just be smart about it, right? Don't be greedy. Like if you're getting 20, 30, 40% return, they're not bad. They're amazing. Like imagine making that kind of return on stocks. It will take you years.
Yep, for sure. All right, and I'm gonna cover a play here real quick. Let me pull it up. It is the SPY. So just to be very clear, I've been getting this a lot. People keep asking me, hey, what leaps are you in? What leaps are you in? I'm not in any leaps, okay? I mean, I am in leaps that I had gotten a while ago. They're dead. They're like 98% down. XLK, XLV. The only one that's up is XLR. I'm sorry, XLE. That's the only one that's up right now. But this is just a play and an idea that I would have and I may actually do this one once the time frame comes. I am on the weekly chart. I'm looking at the SPY. I have the demand zone plotted here, which is from 362 to 368. Now, I don't think it's going to happen tomorrow. Like Mo was saying, we will likely rally for 2 days, but this is in the future. I really believe that this is going to come down to this area. What you will also know is that on the bottom of the demand zone level here at the 362 is also where the 200-day moving average is at. And if you align that with the RSI, if SPY dips down to 362, the RSI will be completely oversold. So if I would get into a leap, for one, it's going to be really expensive because it is a SPY. So I would likely probably do 6 months out. But if you can afford a year, good on you. But expect to take a hit if it does drop below that. I repeat, expect to take a massive drawdown if it ends up dropping below. And if you go green, if you get multiple contracts, start shaving off and do not hold to get greedy and hoping that this one play will, bring back your entire portfolio of losses for the past year. You have to be extremely careful. But this is the play that I have, and this is just strictly based off of technicals. Again, the 200-day moving average is hitting the bottom of the demand zone, and at that point, the RSI will be completely oversold, and that gives me kind of like 3 indicators that this could be a good play for a leap. The minute I see positive, if you're like 100%, you should probably get out. That's just me. Again, I'm not a financial advisor. This is not financial advice. I was just looking at a play because people always ask me, hey, what leaps are you planning on getting into? What call positions are you planning on getting into? And I'm like, I'm not getting into anything right now because, again, fundamentally, the market's weird. So this is just an idea that I had. Again, you're on a weekly, so you could pull up the weekly. You find the demand zone. We're getting really close there. I mean, we dipped all the way down to 370. So all it is just another 10 points, and then you'll be there. But like Mo said, we're probably going to rally. We're probably going to fill up that gap right here. And if I would get into this position, if I would execute into a leap on this play, I wouldn't get anything further out than 400. In my personal opinion, I wouldn't go above that. So what are your thoughts on that, Mo?
My thoughts are simple. So look at what happened in the market on Friday. We closed at a round number, 3,800, right?
Mm-hmm.
And Monday we were down 120 points, right? So personally, I don't think this is the time to buy leaps for 2 reasons. One is RSI is very subjective. Oversold doesn't mean it's going to bounce. It just means it's oversold, and market can stay oversold for weeks, days, months, right?
Mm-hmm.
That doesn't matter. Second thing is, if you are someone who is trying to grow your account, leaps is the wrong way of going. You want to, because your capital is blocked. I would play short-term calls if I had to. The third thing that I personally faced, your risk management gets a little bit wonky when you have leaps because you keep telling yourself you have time. So what I mean by that is, let's say you buy it there, and overnight the next day it's down another 100 points. You might tell yourself, fuck, I have 6 months left, but on paper you're going to be down 30 to 40%. So
Or more.
or more. So that's my only thing, but I get why people play leaps because they work a job or business, they don't have time to or they don't like the volatility weeklies bring. So I get that part. But that's why I don't personally play it, but I can see why some people would want to buy it. I like Mark, you could also maybe look at in the money leaps, and maybe I don't know, even then that's scary because in the money you can execute the order and buy stocks if that's what you want to do.
Yeah, I actually prefer to get closer to the money. That's what I was saying. If I would do this play, I would not go over 400. I would try to get as close as possible. And when it comes to the leaps, I'll probably get 3 months out, only because, again, like you were saying, it's going to cost you a lot of money to get a year-long leap on SPY. But like I was telling you, I think in one of the other podcasts before, I've been doing a lot of research on why institutions are putting money deep into money. So deep into money. Like, for example, people are got probably $250 SPY calls and stuff. There's a reason for that, which I understand. But the average person really doesn't have thousands and thousands of dollars for a single contract. And this one alone is probably going to be thousands of dollars. And my recommendation, when I always say, again, I'm not a financial advisor, but just having conversations with people and they're like, hey, what what calls are you gonna get XOK, XOY? I'm like, look, at this point, if you're willing to get into a leap, and if you don't have a plan to exit, because again, you have time, and that's like you were saying, right? That's the whole purpose of leaps. You have time, right? You have time for it to mature. You have time for it to bounce back, and etc. But tell that to the people who got leaps here thinking for 500 by the end of this year. It's probably not coming back. It's probably not coming back. And they probably held because they're like, oh, I could manage to draw down a little bit and then it will reverse and it will go back out up. It's probably not going to go back up. That one's probably dead. Just like I said, my XOK, I'm down like 98% on my 2023 XOK, and that was for 170 when XOK was at 150. But when I got that position, when I got that call for one, I knew that we were likely heading into a somewhat turbulent road this year. And the money that I dropped for it, which was $1,600 a contract, I was okay with letting it run to zero, which is crazy. I know I should have probably taken it out. But when I got that, I told myself, I was like, I know there's a lot of stuff that's going to happen this year, but I'm hoping that we'll recover quickly and I can 1x this. It did not work, and I was okay with it going to zero. I can sleep at night. If you cannot sleep at night with the money that you put in leaps, don't do it right now. Just don't do it. Leaps work best, honestly, in a bullish environment, in my opinion. I know some people will probably disagree, but for me, a bullish environment is where leaps really flourish, and we're not in a bullish environment right now. But again, this is just like people keep asking me like what play I would do. This is one that I like. Mo doesn't agree with it. That's a good thing about us. You see, two different people, two different opinions. You do your own DD, but that's a play that I would do if I was interested in getting into any leaps. And again, 3 months, 6 months, it depends what the price is. I would have to look at it. I would just look at the charts and I was like, this seems like a pretty damn good setup in my opinion. All right, there you go. All yours, Mo.
All right, so the lesson for this week is for all the new traders or all the traders that are having issues growing their account. And I want to talk about execution. Like when you get in a trade, you're kind of feeling nervous or you have anxiety. Being nervous if you're new, that's fine. But having anxiety, basically, you're kind of reacting to every candle. What you need to do is sit down and grab a blank piece of paper and ask yourself what your risk tolerance is. And your risk tolerance has nothing to do with how much money you have. So let me give you an example. I might have $50,000 in my trading account, but my risk tolerance is that I cannot lose more than 10% of it, right? So that's 5,000. Mark, however, has $2,500 in an account, and he's like, I don't care if this all goes to zero. Not that kind of attitude, but like that's his risk tolerance. 2,500, he can blow it, and it wouldn't, like, if he's in a trade and if something happens and it goes to zero, he doesn't care. That's his risk tolerance. My risk tolerance is 5K. It's not 50K. Just because I have 50K in my account doesn't mean anything. So what happens with the guy who has 50K or a girl who has 50K, sometimes they'll start playing with 10, 15K because they have 50K and they feel like they can. The problem though is that amount is too close to their risk tolerance. So what you need to do is once you identify your risk tolerance, you need to just play with that amount. So if you can't lose more than 5K, especially in short-term options, then you take that 45K transfer in a different account, you trade with 5K. And within that 5K, I always tell people, because most of you guys will have a cash account because a lot of people don't want to put 25K so they can trade day trade every day. So what I would recommend, always keep half liquid. So let's say you have 5K, $2,500 will be liquid at all times. The rest of the $2,500, if you're new, I'd say play less but have bigger size so you can scale in and out when you do start seeing profits. The reason why you want to keep the rest cash is we're in a news market where something always happens every half an hour. So sometimes an easy play will come your way. And at that point, if you don't have cash, you're going to basically lose on a big opportunity. So what I mean by that is I see a lot of traders, market opens 30 minutes, they've exhausted their capital for 20, 30% gain, and now they have nothing in their account. And then better plays come and they can't do anything. So that's that. Third thing you want to identify is what kind of trader are you? I know someone who plays with 50K and their only goal is to take 10% a day and get out. So they will go on a high probability setup and have a 1 or 2% stop loss. That's their way. I know someone else that only does swing plays, and what they do is they'll go spy calls 3 months out, but their focus is only to take 20-30% out. And then I have people like me, we trade weeklies and we can handle the volatility. So you need to ask yourself, what's your trading style? And then once you know, you make rules according to that. So one of my rule is I need to have a certain amount of money in my account. It makes me feel better. It's kind of like someone who starts getting anxious if they don't have that much money saved up,
I'm that
right?
guy.
Right.
I'm
So that's why, recession's coming. Well, how does it impact me? It's not always about money. It's about peace too. If you are fine and your mortgage payment, shit like car, all that stuff is figured out, and you don't have a certain amount of savings, it'll still give you anxiety because what if something happened, and then what if can eat your peace and all that shit. So figure that out in trading too. Like I have a certain amount that I have to have, and I don't trade remotely to that amount anymore, but I need to have that amount to make me feel comfortable trading and taking the risk. So that stuff is important. And then the last is we've gone over comparing. Once you've identified your risk tolerance, your trading type, and what your rules are, you cannot compare because you just are a different profile now. You might be able to like compare with someone at the same profile, but it's almost impossible to figure out what the other person's profile is because most people don't know what kind of trader they are. Most people learn that over the years, fuck, I shouldn't do this, I shouldn't do this. In trading, it's not about making money, it's about risk reward. At times, you can make money, but if the trade goes against you, you don't want to accept that loss, so you don't take the trade. And which brings me to my last point. A lot of people are getting into trade not assuming any loss. And what I mean by that is someone gets in a trade, especially SPX, and you're not assuming a 10, 20, 30% loss, and then you get out 10%, you get pissed off, and they're like, fuck, I'm done for the day. And then you see another trade, you're like, I'm going to not take this, and that one goes 500%. People see me do that every other day where it's like the day is fucking boring, nothing's happening, and all of a sudden, this happened I think Friday, I got a play for 55 cents that went to $35. I got out at $7 and then I rolled it, but truly the rolling was a dumb idea. It was the whole trade was 55 to 7, but a lot of people didn't get in because they got stopped out, and that tells me they're not assuming the loss. And like it's kind of like you open a business, you buy inventory, there's going to be dead inventory. That's cost of doing business. So go read the book Trading in the Zone. It talks about a predefined loss. How can you get in a trade without having a predefined loss? And I can tell you that most people don't have it. So that's something, these are very key areas to become a successful trader. If you don't have any one of them, you're going to have an issue, and it's going to be a psychological issue where you're going to not feel peace. And that's when you go erratic and get restless and then start taking bigger risk, or just get fumbled out of a trade and then a trade goes. So that's stuff that like it's really deep and a lot of people don't talk about it, and people just go over the surface. But this stuff is important for you to trade. The technical shit comes afterward. If this isn't figured out, that technical stuff isn't going to help you.
Yeah, you just talked about the fact that you need to find out like what type of trader you are and what type of strategy works for you. I think a lot of us have been kind of just stuck on just doing calls and puts and no other strategy. But there's so many out there, and I think we mentioned that in a previous episode as well. Like you should go out there, you should learn straddles, you should learn butterflies, you should learn iron corridors, you should learn all these different strategies. Like you should learn to see like what works best for you and then stick with it. If you've got one that works for you, stick with it. And you should be practicing these on paper trading, not with your own money. See, option is different. Like on futures, I recommend people, practice for 2 weeks and then go to the micro minis, but that's different. I'm talking about with options. If you want to get into day trading with options, figure out which strategy works for you. I know there's a lot of groups out there and they just teach just the basics, puts and calls, and that's basically it. I know that. So all we've been exposed to is just puts and calls. but there's other strategies out there that work in various different environments. And I think it's very smart for people to go out there and actually hit the books. If anything, this is the time to do it right now because the market is so volatile and we're in a bearish territory. This is really the time. If anything, like I said again, I'll repeat it over again. I am all about stacking cash right now. And this is your opportunity to really study and learn and maybe take a little bit of that cash and then try to become a day trader or try a day trade when you have free time and learn different methods. And again, learn your risk tolerance. One of the biggest things that I learned from Mo, and is really, which really changed my entire trading game, was journaling. You told me about journaling. I mean, I know I've heard it before, and other people, in trading is only talk about journaling and stuff like that. But you gave me a journal, which is just a basic Excel spreadsheet. And when you write it down and you visually see it, you see what you're doing wrong. You see if your losses outweigh your wins, if you are taking, if you're getting out too early, but then you're letting your losers run way too long to the downside. You see all that stuff, and you could even write in your emotions and everything. All the greatest traders that I know and that I've seen, they have one thing in common: they journal. They journal and they look back and they review and they see, like, how was I feeling at that moment? What was I thinking? What was I doing? And they tweak it based upon that. If you don't have a journal and you're just like, oh, I just had, like 3 bad losses. Okay, well, what did you do wrong? Well, I don't know. I didn't write it down. Or I bought it here. I did it there. Like, you have to write this stuff down to visually see it.
Dude, imagine having a business where you weren't recording anything. This is a business. Imagine playing a sport and not having a scorecard. You're not gonna know. So that's one of the things that I learned in my previous job, where they said you need to have a scoreboard for everything you do. And the example they've said, hey, if you're playing basketball and all of a sudden we don't want to do a scoreboard, how well will you play? There are no winners or losers because you can't track it unless, like, you're mentally tracking it, which is like you're getting away from the game. And you can mentally track it 1 day, 2 day, 3 day, but over a span of 6 months, how do you track your performance? So same thing as traders. If you're tracking your performance based on profit and loss, that's where you're making a mistake, because again, it's a lag indicator. Lead indicator is 3 things that make a trade: your entry, your exit, and your stop loss, right? Figure out where you're good at, figure out where you're bad at, and then focus on that one area. Once you get better, then you move on to other area. The biggest thing that most people suffer at is stop loss, and has nothing to do with technicals. It's because they don't want to be wrong twice. Simple. They are like, it's gonna come back up, and then it's deep in the hole. So you need to figure out which one is a skill issue and which one is a will issue. And skill issue are easy to fix. Will issue is more emotional, and you need to figure out where the trauma is. Fuck, man, this shit goes really deep, and everyone has their own trauma with money and success and failures. How many people do I talk to that take their account from 400 to 4K, then back to 400, and they repeat that cycle every single day? It's the same shit with people that have 5K salary, then 10K and 50K, but the same money problems happen because they keep upgrading their lifestyle. The shit's the same. It goes back to your trading.
Yep. And I'm reading right now this book called The Compound Effect it's by Darren Hardy. Like, I know you guys probably heard of him before. It's that whole penny that it was going viral a couple weeks ago, where people are like, would you rather take 3 million or take a penny a day that doubles or whatever? That's where that came from, by the way. So all the gurus out there were acting like they're the ones who came up with that. No, it's from The Compound Effect. But if you read that book, I just started reading it a couple of days ago. It has a lot of good information in there when it comes to slowly compounding your income and your trades, right? One of the things that his father used to teach the guy was that if, for example, if you're bad at doing 3-point shots, right? When you play basketball, 3-pointers, if you're bad at it, well, go out there and do 500 of them. If you can only dribble or with your right hand, but your left hand is weak, well, then tie your right hand on your back and then dribble with your left hand. You have to work on where you're weak at, like what Mo was saying. Like, you can see, like, is your entry off? Like, is your exit off? What is it? So then practice that over and over and over until you get better with it, and then you can actually execute with real money and be successful at it. It's a compound effect. It's repeating the steps over and over. So I have nothing else, Mo. What about you?
Me too, man. I think we gave up a lot of good information. People just need to sit down and figure out what they want to do
Yep.
and get ready for what's coming next.
Yeah. Yep. And definitely, again, we're in a bearish territory, and they always say, right? In a bearish territory is where people become millionaires down the line, right? So don't be fearful. Again, look at your risk tolerance, decide when you feel it's time for you to start scaling in. I'm going cash right now until then. So peace out, everybody. Until next week, my name is Mark, and who are you?
I'm Mo from OTB Clubhouse. Is our like 10th episode or what?
No, this is I think the 8th one, man, the 8th one. So by the time we hit 10, y'all, once we get over that 10 episode mark, we're gonna start bringing in guests, and then we're even talking about potentially going live eventually. So we just gotta get that subscriber counts up. So if you haven't subscribed yet, make sure you subscribe, smash that like button, of course, click on that bell to get notified every single time we drop a video. We do it on a weekly basis. If you have any questions, please DM us on Instagram at Money Market Truths, or you could email us. The email gets checked once a week. So you're better off probably is getting us on Instagram, and we're gonna start asking questions on there too to see like what you guys want to hear about and participate and stuff. But share, get the information out there. We wanna be interactive because we know we're all in this together, y'all. Your portfolios are down, ours is down. I don't know about Momo, doesn't really invest like that. He's more of a trader, but
mine's down 65%.
Oh, okay.
But it's very small. I want to be fucking honest, man. Like anyone that's telling you they're green right now, unless they're holding inverse indexes, they should be red.
Yeah. Well, especially if you just started. So in the past, like at least 2 to 3 years. Obviously, if you started 15 years ago, I think you'll be fine because Amazon, you probably got it at like $14 or something. Who knows?
Yeah.
Just we're in there together, so don't feel dumb. We all make mistakes. It's a learning process. I love when people always say, it's not a loss, it's a lesson learned. And yes, that's kind of true, but it's also kind of hard to say that when you're losing. But don't worry. I think if you have that patience, don't. One of the worst things to do is to cut and sell stocks, good quality stocks right now. I think that's a really bad idea. Again, I'm not a financial advisor, but if you have good quality stocks, I wouldn't recommend just selling them off because you're down right now. It will come back. Hold it. So until next time, y'all, peace out.